Good morning. It is Tuesday, September 30th, 2025, 11 a.m. or 9:30 Eastern time recording here. Morning market video, global macro. What are we looking at? I haven't done a video in a couple of days, so lots to cover. I got something here for the bulls, for the bears as well, in this backdrop for where we're sitting. To end Q3 into Q1, Q4, sorry, tomorrow, October 1st. And the U.S. government, the biggest business in the world, is going to shut down. Previous government shutdowns, 2013, was basically 16 days of a full shutdown of the government. The resulting impact on the economy at the time was about 60 basis points negative GDP. On a full shutdown back then, about 4 basis points of GDP per day shaved off growth. So the government, whether it's wasting capital, wasting spending, yes, arguably it is a product of GDP growth. And we are going to have potentially a shorter pullback here in growth from that standpoint. 2018, 2019, the government shut down 35 days, 40 basis points of GDP growth back then. Bottom line is a government shutdown probably equates to lower bond yields in the U.S. shorter duration. Looking at the 2-year yield here, shorter bond yields equals shorter servicing or lower servicing cost on the interest of the U.S. government debt. They keep using the shorter duration, 4-week to 2-year Treasury bills issuance to finance the government. The lower that yield, the easier that is, which really plays into the whole concept of yield curve control, stealth yield curve control through Treasury Secretary Scott Bessent, the Trump administration. Plus, it's no surprise that the government needs to be cut and Trump wants to do some cuts there. So if anything, they're probably encouraging this for a couple of weeks. You can potentially see here. What does it mean for markets? Besides lower bond yields, a lower US dollar, and higher gold, highest precious metals. We have gold here going for a crazy psychological potentially here to end to start Q4. 4,000 US dollar an ounce. I can't believe we're 4,000 an ounce gold and there's not crazy chaos in society. It's not the gold is at 4,000 an ounce, it's that the fiat money has failed that much. It's down 50% in the last 5 years. Truly astronomical. And like paper markets get broken by physical demand. The manipulation of precious metal markets is through that paper facility of COMEX and different playing games. You look at history, how many big banks have been fined for spoofing in the precious metal markets continue to operate. In my book here to start to do the day, the strongest signals yesterday, the end of the day trading, we got silver all-time highs approaching potentially $50 an ounce US. Looks really strong. Nvidia, despite the biggest company in the world, it continues to be super strong here in its flows into markets. That passive bid continues to go in to Nvidia, representing about 7.5% weight in the S&P 500, and had almost a 17% impact yesterday on the S&P. So I see stronger flows back in Nvidia here with this backdrop. Yesterday it was 265,000 of the 185 Nvidia calls that's going to trade and in here on the week. So that's pushing the stock, the tail that wags the dog, potentially to 185, 186, 187 even. Microsoft, Amazon, Apple, Google, they make up those big numbers really make up the majority S&P market cap. And as long as they stay strong, bullish trend here, the S&P and the U.S. equity market wants to go higher, especially with the backdrop of a lower U.S. dollar, lower bond yields, gold, super high signal, even Tesla, super high signal here from a bullish trend standpoint. So indications indicate we're going to continue to rally into these all-time highs. Australia out last night, no change in its interest rate policy of central bank. They cut back in April, they cut back in July, and now they're sitting on their heels here in Q3. European economic data, slowing growth in Germany, stagflationary environment here throughout Europe. Great Britain, same themes. Look at the business investment, massive rate of change slowdown year over year and month, quarter over quarter in the UK. Similar GDP. German retail sales, big slowdown as well. So bearish on the economic output in the UK, into Germany. UK really setting up for that stagflationary environment. US commercial real estate market. Let's look at the office space. A lot of dead capital out there. Look at the delinquency rate in the office sector. Most of these buildings can never be repurposed for anything else because of how they were structurally built years ago and not cost effective to turn them into residential. Somebody's dead is somebody else's asset. All the mortgages are sitting inside. These loans kick the can down the road for lenders don't want to realize. But there is stress in that side of the market. The side of the market in commercial real estate, which is strong, the data centers, the electricity rates being driven up to the consumer as a result. The build out is just continues to be massive in the data center space. However, good podcast to listen to yesterday. Eye-opening perspective on the bubble that is the data centers. So much money being thrown at the building itself, the actual components that feed into it for the electricity, etc. But the GPUs that operate inside of these data centers, those Blackwell, NVIDIA chips, they're going to have to get replaced every 2 or 3 years. That's the depreciated value on those data centers. So the massive capex to build them is one thing, but then to continue to replace them every 2 or 3 years, where are you getting the money for that? It is a massive bubble, but when does that end? I don't know. But this old take in a book from 1996, 1990, I came across with some of my files. Just look at the stuff they're talking about here. A lot of it relates to AI and similar things we're seeing today, talking about bots, artificial intelligence. So it's not a new thing. It's just the size and the scale of it here now, words too. The railway changed the way the world operated. The internet changed the way the world operated. Fiber optic changed the way the world operated. But there was a imploding of those bubbles along the way. That's not to say this is not going to be a game changer for everything. But are we too far over our skis in terms of some of the expectations for some of this stuff? Potentially, yes. Year to date, where we're seeing bankruptcies in certain sectors in the U.S. Manufacturing, which Trump wants to revive from east back to west, doesn't seem to be going in that direction currently. Big layoffs today, and then it's in the oil and gas sector. Exxon laying off 2,000 of its employees. So unemployment rate could tick up here in the U.S. into Q4. That government shutdown with some other sectors, which will be also bullish for bonds, bullish for precious metals, as those yields will continue to fall in that backdrop from a macro standpoint. Let's look at the best performing sectors in the S&P here to end Q3. Outstanding performance by gold. The GDX sector, gold miners continued to outperform because of that high spot price. The automotive sector, surprisingly, Tesla is on a massive run, so that's probably driving that as well. The electronics sector, this is what we're looking at here to end Q3. And why we potentially could have a cautionary. I was bullish during the first part of the presentation, but we are going into the blackout window for corporate buybacks, which is the biggest part of the market that really puts a bid into that passive side of the market. Companies buying back their own stock, they are in the blackout period now here into the latter part of October. So potentially a big part of the market is on hold. Probably chop wood around 6,400 to 6,700 in S&P before we get through that and then into all-time highs the end 2025 is my outlook. Debasement, higher precious metals. That's what I got for you today. See you soon.